March 15, 1978. Federal Courthouse, Chicago. Allen Dorfman walked up the marble steps wearing a $2,000 tailored suit and carrying a briefcase worth more than most Americans made in a year. Inside that briefcase were documents showing how $1.4 billion in workers' retirement money had been systematically looted by organized crime over 2 decades. If you're enjoying this deep dive into the story, hit the subscribe button and let us know in the comments from where in the world you are watching from today. Dorfman, 55 years old, wasn't a typical mobster. He'd never killed anyone, never broken legs, never robbed a truck. But he'd done something far more sophisticated. He'd turned the largest pension fund in America into the mob's personal bank account. And the workers whose money he stole? Most of them had no idea they'd been robbed until their retirement checks stopped coming. This is the story of how the Mafia didn't just steal millions from the Teamsters Central States Pension Fund. They stole billions. How they turned union solidarity into organized theft. How they built Las Vegas with truck drivers' retirement money. And how one man's greed destroyed the financial security of over 500,000 American workers. But here's what makes this different from every other mob story you've heard. This wasn't about violence or territory wars. This was about patience, insider knowledge, and understanding that the biggest scores don't come from armored cars. They come from paperwork. The Central States, Southeast and Southwest Areas Pension Fund was created in 1955 during the golden age of American labor unions. Jimmy Hoffa, president of the International Brotherhood of Teamsters, negotiated a revolutionary deal. Instead of individual company pensions, Teamster members across 22 states would contribute to one massive fund. Employers would pay in. Workers would collect when they retired. Simple, fair, and legal. By 1960, the fund controlled $300 million. By 1970, over $1 billion. By 1975, $1.4 billion. That's roughly $7 billion in today's money. It was the largest private pension fund in America, controlled by a small board of trustees, most of them loyal to Jimmy Hoffa. Here's where it gets interesting. Federal law required pension funds to make prudent investments. Government bonds, blue-chip stocks, real estate with guaranteed returns. Safe, boring, profitable. But the law also allowed something called mortgage loans to businesses, as long as they met certain criteria. Legitimate business plans, adequate collateral, reasonable interest rates. Allen Dorfman understood that loophole better than any lawyer in America. Dorfman was born January 6, 1923, in Detroit. His stepfather, Paul "Red" Dorfman, was a Chicago labor leader with deep connections to organized crime. Red had helped Jimmy Hoffa rise through the Teamsters ranks in the 1940s. When Allen graduated from college in 1950, Red got him a job as an insurance broker for Teamster health and welfare funds. Allen was smart, patient, and understood something most criminals never figure out. The biggest money isn't in the streets. It's in the boardrooms. By 1957, Allen Dorfman had become a trustee of the Central States Pension Fund. He wasn't officially supposed to make lending decisions, but in practice, every major loan request crossed his desk first. He developed a system. Legitimate businesses got standard treatment. Thorough background checks, financial analysis, strict repayment terms. But mob-connected businesses got the express lane. The first major score was the Hacienda Hotel in Las Vegas, 1961. The casino needed $5 million for expansion. The loan application listed the borrower as the Hacienda Corporation, a legitimate Nevada business entity. What it didn't mention was that the real owners included Chicago outfit members Jake Guzik and Murray Humphreys. Dorfman fast-tracked the approval. No background check on the real owners. No independent appraisal of the collateral. No competitive bidding process. The loan was approved at 6% interest when the market rate was 8%. The fund lost money from day one. But here's the genius of the system. The Hacienda made its payments on time for the first 2 years. This created a paper trail showing the fund was making legitimate business loans with acceptable risk. When federal regulators examined the books in 1963, everything looked proper. Interest payments current, documentation complete, legal procedures followed. What the regulators didn't know was that the Hacienda's payments were being subsidized by other mob-owned businesses. The casino was actually losing money, but the Chicago outfit was making the pension fund payments to protect their relationship with Dorfman. That successful deception became the template. Between 1961 and 1975, the Central States Pension Fund made over $300 million in loans to businesses with hidden mob ownership. Casinos in Las Vegas, real estate developments in Florida, hotels in California, golf courses in Arizona. All of it financed with truck drivers' retirement money. The most audacious scheme involved the Stardust Casino. In 1969, the casino needed $66 million for a massive renovation. That was 5% of the entire pension fund. A loan that size to a single business violated every principle of prudent investing. But mob bosses from Chicago, Kansas City, and Detroit all had interests in the Stardust. They pressured Hoffa, who pressured Dorfman, who crafted the deal. Instead of one $66 million loan, Dorfman structured it as 7 separate loans to 7 different shell companies, all owned by the same group. Each loan was under $10 million, avoiding federal reporting requirements. Each company had different collateral, different terms, different documentation. On paper, the fund was diversifying its investments. In reality, it was betting everything on one casino. The Stardust loans were approved in March 1969. By December, the casino was skimming $200,000 a month in unreported profits directly to Kansas City and Chicago crime families. The pension fund was earning 5% interest on its $66 million loan while the mob was stealing $2.4 million a year in skimmed profits. The workers' retirement money was financing its own robbery. But Dorfman had a bigger problem: Jimmy Hoffa. By 1970, Jimmy Hoffa was facing 13 years in federal prison for jury tampering and pension fund fraud. He'd been convicted in 1964, but had remained free on appeal for 6 years. Now the appeals were exhausted. He was going to prison, and he needed a successor who would protect his interests. Hoffa chose Frank Fitzsimmons, a loyal but weak Detroit Teamster leader. Fitzsimmons would be the figurehead. Dorfman would continue running the pension fund loans. When Hoffa got out, he'd resume control. That was the plan. It didn't work. President Richard Nixon commuted Hoffa's sentence in December 1971, but with a condition. Hoffa was banned from union activities until 1980. He couldn't officially return to the Teamsters. This created a power vacuum that Fitzsimmons decided to fill permanently. By 1972, Fitzsimmons was making his own deals with organized crime families, cutting out Hoffa's people, including Dorfman. The pension fund loans continued, but now different crime families were getting access. New York's 5 families started receiving loans for hotels and real estate developments in Florida. Detroit's Zerilli crime family got money for casino investments in Las Vegas. The Philadelphia crime family financed construction projects in Atlantic City. Dorfman found himself managing competing interests. Chicago wanted money for new casinos. Kansas City needed loans for existing operations. New York demanded financing for hotel developments. Detroit wanted gambling investments. Everyone expected favorable terms, minimal oversight, and guaranteed approval. The fund was becoming overextended. By 1973, over 70% of the pension fund's assets were tied up in high-risk real estate and casino loans. Federal law required pension funds to maintain diverse, safe investments. The Central States Fund was violating those requirements, but federal oversight was minimal in the 1970s. Then came the 1973 recession. Real estate values crashed. Casino revenues dropped. Several major borrowers defaulted on their loans. The Landmark Hotel in Las Vegas, which had received $17 million in pension fund loans, went bankrupt. The fund lost everything. The Four Queens Casino defaulted on $12 million. The Del Webb Corporation, which had received $57 million for various projects, restructured its debt, paying back only 60 cents on the dollar. Workers started noticing problems in 1974. Pension checks were delayed. Some retirees received reduced payments. Others were told their benefits were being reviewed and payments would resume later. The fund blamed administrative problems and temporary cash flow issues. Dorfman knew the truth. The fund was technically insolvent. If all the bad loans were written off, liabilities exceeded assets by over $400 million. The only reason it was still operating was that most borrowers were making minimum payments, even though their businesses were losing money. He also knew something else. The federal government was watching. The FBI opened Operation Pendorf in 1974. The name stood for Pension Fund Dorfman. Federal agents had been tracking suspicious loan patterns for 2 years. They'd identified shell companies, traced money flows, and documented connections between pension fund borrowers and organized crime figures. The investigation started with a tip from an unlikely source. Anthony Spilatro, a Chicago outfit enforcer working in Las Vegas, had been arrested on unrelated charges in 1973. During questioning, he mentioned that the guys in Chicago were using pension money to finance casino operations. He didn't provide details, but it was enough to trigger federal interest. FBI agents began examining Central States pension fund loan documents. They found patterns: loans to businesses with minimal assets, approvals without proper documentation, interest rates below market standards, borrowers with criminal backgrounds who shouldn't have qualified for any loans. But the paper trail was carefully constructed. Dorfman had spent 15 years perfecting the system. Every loan had proper documentation. Every approval followed technical procedures. The corruption was in the details, and proving it required forensic accounting and inside knowledge. If you find this story engaging, please take a moment to subscribe and enable notifications. It helps us continue producing in-depth content like this. The breakthrough came in 1975. Federal agents flipped Nicholas Savella, boss of the Kansas City crime family. Savella was facing RICO charges and chose cooperation over life in prison. He told investigators everything: how pension fund loans were arranged, which crime families received money, how much Dorfman was paid in kickbacks. Savella's information led to wiretaps on Dorfman's phones and surveillance of his meetings. Federal agents recorded conversations where Dorfman discussed loan approvals with crime family representatives. They documented payments from borrowers to Dorfman's insurance companies. They traced money from pension fund loans to organized crime operations. In June 1976, federal prosecutors unsealed indictments against Allen Dorfman, Frank Fitzsimmons, and 17 other defendants on charges of conspiracy, mail fraud, and pension fund violations. The indictment alleged they had looted over $1.4 billion from the Central States Fund over 15 years. The case went to trial in October 1977. Federal prosecutors presented 847 exhibits, called 76 witnesses, and documented loans to 93 businesses with documented organized crime connections. They showed how pension fund money had financed the construction of Las Vegas casinos that were skimming profits directly to crime families. Dorfman's defense was simple. Every loan was properly documented and legally approved. If borrowers had hidden criminal connections, the pension fund trustees weren't responsible for that. The fund had followed federal procedures and made legitimate business loans. The strategy almost worked. The jury deliberated for 8 days. Several jurors later said they were confused by the complexity of the financial evidence and uncertain whether technical violations constituted criminal fraud. But on March 4, 1978, the jury returned guilty verdicts on all major counts. Dorfman was convicted of conspiracy and mail fraud. Fitzsimmons was convicted of accepting kickbacks. Other defendants received various convictions related to pension fund fraud. Judge Hubert will sentence Dorfman to 55 years in federal prison. The judge called the scheme a betrayal of American workers who trusted their union leaders to protect their future. Dorfman's conviction didn't end the looting. It just made it more careful. With federal oversight intensifying, organized crime families developed new methods for accessing pension fund money. Instead of direct loans, they used legitimate intermediaries. Investment banks would package pension fund money into real estate developments or casino financing deals, taking fees while ensuring plausible deniability for everyone involved. But the damage was already done. By 1978, the Central States Pension Fund faced a $200 million shortfall. Actuarial analysis showed that without major changes, the fund would be bankrupt by 1985. Over 400,000 active workers and 150,000 retirees faced the loss of their pension benefits. Federal authorities took control of the fund in March 1979. The Department of Labor appointed independent trustees and imposed strict investment guidelines. No more casino loans. No more real estate speculation. No more deals with borrowers who had criminal backgrounds. But reversing 20 years of damage proved nearly impossible. Many of the bad loans were uncollectible. Borrowers had disappeared or declared bankruptcy. Collateral had been sold or transferred to offshore companies. Shell corporations had dissolved. The money was gone. The fund's new trustees hired forensic accountants to trace the missing money. Their report, completed in 1981, was devastating. Of the $1.4 billion in questionable loans made between 1955 and 1977, only $600 million was recoverable. The fund had lost $800 million in principal, plus 20 years of compound interest. Workers bore the cost. In 1982, the fund reduced benefits for new retirees by 30%. In 1985, cost of living adjustments were eliminated. In 1987, early retirement options were canceled. Thousands of workers who had planned to retire in their early 60s had to work until 65 to qualify for reduced benefits. Some workers lost everything. The fund's trustees discovered that several Teamster locals had never properly enrolled their members. These workers had paid union dues for decades believing they were earning pension credits, but their money had been diverted to other funds or simply stolen by local union officials. Eleanor Wojcik, a 67-year-old Detroit widow, received a letter in 1983 informing her that her husband's pension benefits had been terminated. Her husband had driven trucks for 38 years and died expecting his wife to receive survivor benefits. The letter explained that due to irregularities in the fund's management, survivor benefits for deaths before 1980 were being reviewed. Eleanor never received another pension check. She died in 1987 in a Detroit nursing home, supported by welfare. Allen Dorfman never served his 55-year sentence. On January 20, 1983, he walked out of a Chicago restaurant after having lunch with Erwin Weiner, a mob-connected bail bondsman. As they approached Dorfman's car in the parking lot, two men approached from behind. 7 shots to the head. Dorfman was dead before he hit the asphalt. The murder was never solved, but the motive was clear. Dorfman had been cooperating with federal investigators. He was providing information about organized crime's use of pension fund money in exchange for a reduced sentence. Someone decided he knew too much. Frank Fitzsimmons died of cancer in 1981 before serving any significant prison time. His successor as Teamsters president, Roy Williams, was convicted in 1982 of conspiracy to bribe a U.S. senator and sentenced to 55 years. Williams was succeeded by Jackie Presser, who was secretly serving as an FBI informant while running the union. Presser died in 1988 under federal investigation. The pattern was clear. Every Teamsters president from 1955 to 1988 was either convicted of federal crimes or under investigation when they died. Jimmy Hoffa never regained control of the Teamsters. On July 30, 1975, he disappeared from a restaurant parking lot in suburban Detroit. He was declared legally dead in 1982. The FBI believes he was murdered by organized crime figures who feared he would expose their control of the union and the pension fund. The Central States Pension Fund remained under federal supervision until 2019. During those 40 years, independent trustees slowly restored its financial health through conservative investments and strict oversight. The fund regained solvency, but benefits remained permanently reduced compared to what workers had been promised. In 2003, Congress passed the Pension Protection Act, largely in response to the Central States scandal. The law strengthened federal oversight of pension funds and increased penalties for fiduciary violations. But for the workers who lost their retirement security in the 1970s and 80s, the legislation came too late. The Central States Pension Fund scandal wasn't just about organized crime stealing money. It was about the destruction of trust in American labor institutions. For decades, the promise of union membership was simple: pay your dues, work hard, and we'll take care of you in retirement. The mob broke that promise and nearly destroyed the labor movement in the process. Today, union membership in America is at historic lows. Workers are skeptical of collective bargaining and wary of turning their financial futures over to union leaders. The Central States scandal is one reason why. When workers see pension fund money stolen by organized crime while union leaders look the other way, they lose faith in the entire system. The Las Vegas casinos built with stolen pension money still operate today. The Stardust was demolished in 2007, but the Fremont Street casinos that received Central States loans in the 1960s continue generating profits for their current owners. The workers whose retirement money financed those casinos never shared in the profits. Allen Dorfman's insurance empire was dismantled after his death. His companies had generated over $50 million in commissions from Teamster business over 25 years. Most of that money disappeared into offshore accounts or was spent on legal fees. Dorfman's widow received a modest settlement from his life insurance policy. The families of workers who lost their pensions never recovered their losses. There was no compensation fund, no restitution, no acknowledgement beyond the dry language of federal court documents. They simply received smaller pension checks and the knowledge that their union leaders had betrayed them. But here's the part that makes this story different from every other mob scandal. This wasn't a crime of passion or territory or revenge. This was systematic, patient, institutional theft spanning 3 decades. It required the cooperation of hundreds of people, union leaders, pension fund trustees, lawyers, accountants, investment advisors, and federal regulators who chose not to look too closely. It worked because it exploited the fundamental weakness of any large institution, the assumption that people in positions of trust will act in good faith. Allen Dorfman understood that assumption and built a career on violating it. The Central States Pension Fund scandal proved something law enforcement had been slow to recognize. The Mafia's real power wasn't in violence or intimidation. It was in corruption, the ability to turn legitimate institutions into criminal enterprises, the patience to steal systematically over decades rather than grab everything at once, and the willingness to destroy the financial security of 500,000 American workers in pursuit of profit. That's not just theft. That's betrayal on a scale that reshapes society's faith in its own institutions. The mob didn't just steal money from the Teamsters' Central States Pension Fund. They stole the idea that workers could trust their leaders to protect their futures. In the end, that may have been worth more than all the money they took.